Good afternoon. Today's November 1st, 2016. My name is Joe Terril, President of Terril and Company, independent investment advisors in St. Louis, Missouri, with approximately $700 million in assets under management. We wanted to update our thoughts on world economies, the market. We're a week from the presidential election today. And as always, helping me is Brian Curtis. And Brian, if you're ready, let's turn to talking about the world economy. Economies around the world are doing just fine, including the United States. Recent figures on GDP growth in the United States picked up, showing that we're experiencing something closer to 2.5–3% growth. Europe is beginning to show that its economy may finally, after years, beginning to turn a little bit. Economies in China and India are doing just fine. Our overall outlook for all of these countries on a combined basis is that the world economy is going to do better, and we're going to see a pickup in the world economy. Intrinsic demand for goods and services seems to be finally coming back. In the United States, consumer spending is at an all-time record. Number of miles driven is at an all-time record. So there are positives out there about the economy, and we look for these things to continue. Most economies are still experiencing very friendly monetary accommodation from their central banks, whether it's the Federal Reserve Bank of the United States, whether it's the Bank of China or the European Central Bank. This is helping create a very positive environment for economic growth. It does not work like Keynesian economists think it should, and it does, but easy monetary policy does tend to drive growth. If they, meaning economies around the world and even here in the United States, if they could figure out how to cut some of the government regulation and the bureaucratic red tape, economies would do even better. So, as we've said in our previous comments of last month and even before that, we're very bullish about world economies, but this does not carry over to being bullish about investment markets. So Brian, if we can, let's switch to talking about investment markets, and we'll explain why. Investment markets will struggle in the next 12 months. They will struggle because inflation is beginning to pick up. It'll continue to pick up. As inflation continues to pick up, interest rates will move higher. The move up in interest rates will not be enough to ruin the economy or postpone major purchases, but it will be enough of a move up. Perhaps a 10-year government bond that the last time we did a monthly update was around 1.5%, is at 1 7/8 right now, on its way to 2.5 to 3%. Historically, very modest rate, but that's enough to really affect bond prices, where most people that are invested in bonds are going to see the principal value of their bonds go down dramatically. And it's enough of an increase that stocks, which are selling at a multiple of approximately 17.5 times earnings, could fall to being only priced at 15 times earnings. So the economy will do okay. It's just that in an environment of a stronger economy with inflation moving up and interest rates moving up, it'll tend to make investments, particularly stocks and bonds, worth less. This won't go on forever, but it will for the next year, maybe even 18 months. So we continue to be very cautious in our bond portfolio, maturities are as short as we can get them, and we own floating rate paper. And in stocks, we're at the very low end of our asset allocation range, and even trying to buy some things that perhaps are market neutral as part of that asset category. So this isn't much of a change from what we've been saying for the past 60 days, but what has changed is we're even more confident today of this outlook than we were 90 days ago. This is beginning to happen, and it will continue to happen, and the world will survive it and will move on, but it's a time to be very cautious about financial investments. We have the election coming up a week from today. Guesses as to who's going to win and what's going to happen are all over the board. In general, investors from outside the United States, which are big participants in the U.S. markets, are beginning to worry that either one of the candidates is a bad choice, which perhaps people in this country, have some of that feeling also. This short term will affect the markets to the downside, but longer term, regardless of which candidate wins, I don't think they're going to be able to initiate any of their policy initiatives that certainly they're running on and telling the public that vote for me because I'm going to do X, Y, Z. I don't think there's a chance that they're going to get X, Y, and Z approved, and I also don't believe they really mean it to begin with. So I look for more of a political stalemate like we seem to have experienced in the last 12, 15 years in the United States. So whatever downside move we have because of the election, if we have one, we will use that to look for opportunities. But the world is not really hinging upon what happens in the U.S. election. What's going to happen overall to inflation and interest rates is 10 times as important, and that's what we're continuing to monitor. We thank you for joining us this afternoon for our update on our thoughts about economics and the investment markets. Brian, thank you for your help as always. And we'll be back as needed to update our thoughts, and or if politically there is something that looks like it's going to happen that we're wrong about, we'll be back to talk about how we think that will affect investment markets. Thank you for joining us today. Once again, I'm Joe Terril, President of Terril & Company Private Wealth Managers in St. Louis, Missouri.